So, James, I saw that the amount of debt held by foreign countries, the amount of U.S. national debt held by foreign countries, is actually a smaller percentage than it used to be. And so, this sounds like it might be a good thing. The U.S. gains a little bit of independence from these foreign countries that hold the debt. Is this a positive step that foreigners
Absolutely
owning
not.
less? No.
Absolutely not. It's a terrible thing. It's a terrible thing. There's a lot of people who would have this knee-jerk Americana reaction and say, "Yeah, yeah, we don't need that Chinese money." No, trust me. You want that money. You want that Chinese money. You want that Saudi money. You want that Australian money. You want the. It doesn't matter. You want all the foreign money you can get your hands on, because foreign investment is the closest thing in economics you get to a free lunch. You know, that famous expression, say there's no such thing as free lunch. That's as close as you get. Because what it means is you can run your idiotic deficits, and you have foreigners that are funding it, right? And so essentially, you get it's the Chinese that are taking the risk of funding America's deficits, which, I mean, realistically, there's almost no hope of ever being repaid at this point. I mean, you got 37 trillion dollars almost in debt. They're going to add another 25 trillion dollars, according to the government's own forecast, another 25 trillion dollars on top of that over the next 10 years. Just, to make sure people are keeping score, that's 62 trillion dollars of U.S. national debt over the next decade. It's an unbelievable amount of money. So yeah, you want foreigners buying that debt, because if foreigners aren't buying that debt, if foreigners are not consistently coming into the U.S. bond market and buying U.S. government debt, then who else is going to do it? Somebody's got to do it. Somebody's got to loan money to the Treasury Department. Somebody's got to finance those annual budget deficits. So who's going to do it? Because it ain't going to be me, right? I mean, they're going to need people. They're going to need individuals. They're going to need businesses. They're going to need banks. They're going to need all these people to, if it's not foreigners, they're going to need all these people in the domestic U.S. economy. They're going to need Americans to do it. And there's plenty of savings in the U.S. I mean, it's like 15, 20 trillion dollars of savings sitting on the sideline. So sure, there's money that can be used in the U.S. But you're talking about an environment where there's a finite amount of capital. In an environment where there's a finite amount of capital, everything has an opportunity cost. So if the let's just say market, big M, if the market goes out and funds $10 trillion of its savings into U.S. government bonds, well, guess what? That's $10 trillion. And that money comes from maybe individual investors, guys like Elon, banks like JP Morgan, companies like Apple, whatever. I mean, all these, hedge funds, whatever. Well, guess what? That's $10 trillion that's being invested in U.S. government bonds that's now not being invested in real estate, in startups, in the stock market, in all sorts of other, things out there. So there's an opportunity cost of that. That means that startups are going to have a much more difficult time raising capital, which might mean that new ideas, innovation, et cetera, get squashed, especially for things that might be capital intensive, that there might be less money available for, things, startups that are in nuclear fusion or things that are really like game-changing technology. There'd be less money that goes into the stock market. Well, what happens if there's less money in the stock market? Stock prices fall, returns get lower. So households feel less, or there's less money going into real estate, which means that banks don't have money to fund mortgages. It means that mortgage rates go up. It means it makes it even more expensive now to buy a house. So there's an opportunity cost for all those things. If you have foreigners coming in, then you get to have your cake and eat it too. You've got foreigners financing the deficit. And all of that domestic money in the U.S., it gets to go into nuclear fusion. It gets to go into mortgages. It gets to go into all these things. Your stock market's going up. Everybody feels wealthier because the foreigners are rather stupidly putting their capital into funding the U.S. federal deficit. So that's the benefit. The other answer to the question is like, well, who's going to pay for it if not the foreigners? The other answer is it could be the Federal Reserve. And then how does the Federal Reserve do it? This is where I said earlier that in a normal environment, capital is finite. Well, with the Federal Reserve, capital is not finite. Capital is infinite, because the Federal Reserve we say print, but I mean, it can expand the money supply as much as it wants. The Federal Reserve can say, poof, let there be money, and there's money. And they could do that 10 trillion, 20 trillion, 50 trillion. They could create as much money as they want. And so, the Fed could come in and say, oh, hey, the Treasury Department needs, $20 trillion, over the next several years to refinance the debt and to fund their deficits and so forth. Fine, yeah, we'll do that. Poof, no problem. they create $20 trillion, which sounds great, right? Talk about having your cake and eating it too. The only problem is it comes at a cost. And the name of that cost is inflation. Because when the Federal Reserve creates lots and lots of money, you get inflation. We know this from our own experience because 2-3 years ago during the pandemic, they created $5 trillion. They expanded the money supply. They created $5 trillion in new money, and we got 9% inflation. So, how much inflation is going to be created if the Fed conjures 10, 15, 20 trillion dollars out of thin air? Nobody knows the answer to that question. But it's probably not going to be zero. It's probably not going to be 2%. It's probably going to be a pretty significant number. And that's what we've been saying this for a long time. That's what people need to be prepared for. People need to get ready for a serious bout of inflation in the coming years.
You said earlier that with the amount of debt that's coming online from the U.S. government, there's no hope eventually of them paying it all back. Do you literally mean that they're going to default on China and not pay them back, or is the big risk that they just pay them back in such inflated dollars that it's worth the investment?
I don't think the U.S. government is going to default. They might selectively default. They might, in the same way that we already saw the cues to this when they started sanctioning Russia a couple of years back. And when they do that, they start freezing assets. Say, oh, Russia has a bunch of U.S. treasuries, so we're just going to freeze these assets. And you know what, man? That's a default. That's a default. You can claim the moral high ground and say the reason we didn't pay these guys back is because they're evil and they invaded Ukraine and all that. We hate Putin. Fine. Putin's an easy guy to hate. He invaded Ukraine. Yep. Check. But you still have a contract there that says I'm supposed to pay these people back. And so if you don't pay them back, if you freeze their assets, that's tantamount to a default. So that's actually already happened. Could they do the same thing to China? Yeah, I think so. And I think the Chinese know that, which is why if you look at the charts, and this is publicly available information. Don't take my word for it. You can go and look this up online. It's called the Major Foreign Holders Report by the U.S. Treasury. And you can see over time, just plot the chart. You can see the amount of treasuries that the Chinese own. I mean, they had well over $1 trillion a couple of years ago. Today, it's like 700 billion. So, I mean, their treasury holdings are down 30% over the past couple of years. And that in and of itself is a significant decline, a 30% reduction in the treasury holdings. But bear in mind, this also comes at a time when the total U.S. debt has been increasing, which means that not only has China reduced its treasury holdings by 30%, but China's ownership of the U.S. national debt as a percentage of the total U.S. national debt is like less than half of what it was just a couple of years ago. So there will be a lot of people that go, yeah, we don't need that Chinese money. No, you absolutely want that Chinese money. You want that Chinese money because as long as China is dumb enough to keep handing money over to the Treasury Department and financing America's debts, it means that all that domestic capital in the U.S. economy can go to things like, funding mortgages and, the stock market, lifting stock prices, providing venture capital for new startups and innovation, all these things. And if China cuts off its flow of capital back in the United States, it means all of a sudden now there has to be more money flowing back from the U.S. domestic private economy into government treasuries. And again, that comes at an opportunity cost. So you absolutely want foreign capital in the U.S. government bond market. And because there's less and less and less of it now, and we can see these sort of absolute declines and relative declines like we're seeing out of China, that's bad news. And the Chinese figured this out. And they said, we're not willing to let the U.S. government be the counterparty on $1 trillion of our sovereign wealth, because we look at what they did to Russia. And we think these guys are just going to go and they're going to sanction us. They're going to freeze our assets. We're not going to let them do it. So we're just slowly but surely, fairly aggressively, frankly, drawing down our holdings of U.S. government bonds. We think there's better ways to deploy that capital. And so what is China doing with it? Well, they bought a ton of gold. I mean, I don't want to say a ton of gold. They literally bought metric tons of gold. Usually when you say they did a ton of this or a ton of that, it's like a metaphor. No, they if I say they bought a ton of this, I'm actually undersizing it. Like they bought like many dozens and dozens of metric tons of physical gold, because they know, not because they're quote unquote gold bugs, but because they understand that gold, especially at a central bank sovereign nation level, gold is a strategic reserve asset that for them has a lot more upside, a lot more benefit than the US dollar. So that's what's going on right now. I think anytime people go like, yeah, we don't need those foreigners, man, you absolutely, You might not need it, but the consequences of not having them are pretty significant. The more foreigners invest in the United States, the more capital you have domestically to invest in everything else, and that means that stock prices go up. Your real estate market is a lot healthier. It means you have capital available for mortgages, you have capital available for innovation, for startups, for all kinds of things. And if all that money has to get monopolized in economics, it's concept called the crowding out effect. And if all that money gets monopolized by the federal government, means there's less money left over to invest in the market. Stock prices are down, real estate prices are down, mortgage rates are up. It's a bad scenario. So you definitely want to have foreigners investing. And the fact that foreigners are not investing is a pretty big condemnation of the credibility, the declining and waning credibility of the U.S. government.
So this is what you're talking about when you say that foreigners are moving away from investing in U.S. debt. You're not talking about individuals. You're talking about central banks and governments.
Yeah, I'm not talking about some random Chinese guy who lives in Shanghai or whatever. I'm talking about the Chinese government, and I'm talking about the central bank. I'm talking about governments around the world, governments and their central banks around the world. If you look at it, are owning less and less of the U.S. government debt. The percentage of foreign ownership relative to U.S. government debt is falling. And a lot of the kind of the alarming thing is a lot of the big lenders in the past, like China, are really stepping back hard. 30% decline in Chinese ownership of U.S. government debt just in a couple of years is a pretty big deal. And then who are the big, the guys that are the big owners now? I mean, the UK is now the number 2 owner. They've overtaken China. The UK is the number 2 owner of U.S. government debt. The UK is broke, man. They are broke. And so you've got Japan is the biggest holder. Japan is completely broke. So you're talking about countries that are broke that own a ton of your debt. So between Japan and the UK, I mean, you're talking about $2 trillion, north of $2 trillion probably of U.S. government debt. Well, what happens when they're really hard to cash? They're really short. Now, what are they going to do? They're going to go start selling assets. The easiest asset for them to sell. I mean, the UK right now is already selling they said, well, we got all this crypto that we took off of criminals, and so we're going to sell that to raise money. Okay, fine. How long is it going to be until the British government starts selling their U.S. Treasury bonds? Because they don't, they're not generating enough tax revenue. They're not, they don't have the ability to borrow as much. So you got broke governments that own a bunch of your debt. That's not a good situation because they're months or years away from having to liquidate a good portion of their holdings. There's no reason why Japan needs so much U.S. government debt. There's no reason why Britain needs so much U.S. government debt. There's no reason why Belgium needs so much U.S. government debt. So you're going to have a lot of these countries then you start to sell off their U.S. government debt. And who's going to pick up the tab? It's going to be the U.S. domestic economy. And again, that comes at a consequence.
Is there anything to be said for this last man standing theory where, so if individuals did see their own governments like the UK or Japan being in such dire financial straits that they would go and invest in the United States instead of trusting their own domestic governments?
Yeah, I think there's going to be people in the UK, for example, who look around and say, "Man, this place is just screwed. We've got an economy that's in shambles. Taxes are going up, regulations are going up, and all these people seem to care about are protecting the grooming gangs and the illegal migrants who come and commit all these crimes and do heinous things." What a bizarre place to live, and talk about gaslighting their own people. I mean, the British government, it really is. I mean, people use this kind of metaphor a lot, but I mean, it really is kind of straight out of 1984. It's very Orwellian, the stuff that they're doing. And so people look around and say, I want to take my money out of the UK, I want to invest it somewhere else. And so where might people put their money? Sure, a lot of people might put it in the United States. A lot of people might put it in the United States, but they're not going to be buying US government bonds. There's nobody like, I gotta get my capital out of Britain. What am I going to do? I'm going to buy a 30-year US government bond. No, that's ludicrous. That's ludicrous. For want of an option, maybe they put it in a 28-day T-bill. Maybe they put it in a 90-day T-bill, but after 90 days, they're going to figure out what they want to do. And maybe they want to buy NVIDIA stock or something like that, but I mean, these guys aren't going to go buy U.S. government bonds because that's just as ludicrous, right? So that's the thing about the U.S. is that there are a lot of things to invest in the U.S. private economy. But when we're talking about, the thing that moves the needle are government reserves and central banks, because this is stuff that's like trillions and trillions and trillions of dollars. If you're talking about individuals in countries that, that are in decline, that some guy in the UK goes and takes £50,000 and puts it in the US stock market. Sure. And even if it's many thousands, tens of thousands, even hundreds of thousands of people around the world that do that, it's a little, yeah, it adds up to capital, but it's not, it's a drop in the bucket compared to the level of foreign reserves, trillions, potentially tens of trillions of dollars from foreign governments and central banks. What individuals, in aggregate kind of accumulate, it's a drop in the bucket.
That makes sense. Thanks.
Okay.